Welcome to Independent Wealth Planner Strategies with Jennifer Lange, helping pre-retirees and retirees build, preserve, and protect their financial assets in today's volatile market.
Sponsored by WFGInsuranceQuotes.com.
Welcome to today's webinar. I'm Mike Payne, and your host for today is Jennifer Lange. Jennifer is an author, a speaker, and a licensed financial services professional who found her love for financial literacy the hard way. Her career goals were on track as she tackled the hustle and bustle of working in New York City as a corporate manager. That is, until life threw her a curveball that would change her direction. Her mother became ill, and Jennifer only had one choice. She left New York and became her mother's full-time caregiver. It was during this 10-year period that Jennifer learned firsthand the importance of how life insurance protects an individual and a family while they are alive, as well as how having essential estate planning documents can empower family members and relieve burdens. She found a new passion and purpose to help the underserved middle class protect against the emotional, physical, and financial stresses of caring for their loved ones. Currently, she works with businesses and families in all 50 states to acquire business loans, life insurance, and annuities. She is contracted through One Resource Group, and you can contact her through her website, WFGInsuranceQuotes.com. So, without further ado, Jennifer, take it away.
Thanks, Mike. I'd like to welcome and thank everyone for attending today. My name's Jennifer Lange, and this webinar is being recorded and will be available for rebroadcast later on. So please submit all questions via our website, WFGInsuranceQuotes.com. The chat is open, so tell me your name and where you're from, and I'll get to those questions as time allows. I see some names in the chat box already. Hi, Mavis from Washington. Good to see you. Welcome. Jeffrey from Utah, good to see you too. I see Patricia from Michigan. Glad you made it. Well, thank all of you for joining. Today's webinar is entitled Business Owner Succession Planning. And as Mike mentioned, a person can either learn things the easy way or they can learn things the hard way. And in my case, when my mom got sick, I learned the hard way. I, like most people, thought that life insurance was just something you had in order to pay for a funeral. I didn't know that it was such a powerful wealth accumulation and protection vehicle which could help you while you're alive. So I do these webinars and I speak to businesses and organizations because I want to help as many people as I can reach their hopes and dreams and avoid that financial learning curve that I went through. And as a token of my appreciation, everyone on the webinar today will be given access to a free ebook that you can download after the call. I'm a part of an online educational program, SafeMoney.com, and SafeMoney.com is a non-biased guide to retirement income planning and wealth protection strategies. I wanted you to have access to the information on this website right away because this has been a tremendous resource for people that I'm working with. So, regardless of where you are in your retirement journey, you'll find that there are many helpful pieces on there. So, let's get started with the basics. Life insurance can be a highly effective vehicle for financial protection in helping to increase the wealth that passes to your beneficiaries, in some cases over several generations. When properly structured in an irrevocable life insurance trust for estate planning, a life insurance policy can provide death benefit proceeds free of federal income tax and are generally free of estate tax. Life insurance can also help business owners protect their business. In a larger sense, the business continuation strategy begins with the inception of the business and continues throughout the business's life cycle. It involves building the business, increasing its value, and transitioning the business to new owners at the retirement, death, or disability of its founders. The growth and maturity stages of a business can span a period of years. A business in the infant stage is dependent on its founder and often needs the protection provided by a key man life insurance policy. As the business grows and management staff is added, what better way is there to create and build business value than through executive benefit plans? Finally, as the owner ages and the transition stage begins, there is a great need for retirement, estate, and exit strategies. It's important to remember that business continuation is much more than just a formal buy-sell agreement. It is an ongoing process that starts years before the transfer event. The buy-sell agreement is only one part of the business continuation process. For business owners, the business is a major source of family income, a personal investment vehicle, and a major portion of the owner's estate. Without a proper strategy in place for the owners, financial hardships can result for the remaining owners, as well as the family of a disabled or deceased owner. A properly structured buy-sell agreement is one of the most powerful tools for managing the transition of a company's ownership. It allows the business owner or owners to design and structure the business prior to a transitional event in order to ensure business continuity for the surviving owners and financial security for the departing, deceased, or disabled owner's family and heirs. A properly structured buy-sell agreement can create a market for a departing owner's stock, help maintain ownership control within the desired channels, establish a fair price or valuation method in advance of a triggering event, possibly set the value of the business interest for purposes of federal estate tax, reduce the chance of valuation disputes with the Internal Revenue Service, contain directives that help avoid conflicts among family members, provide needed liquidity to handle estate expenses, preserve the business's tax status, and improve the credit risk of the business. The buy-sell agreement is structured as a legal contract that addresses issues such as which events will trigger a sale, who has the right or obligation to purchase a business interest, how the purchase price will be determined, how payments will be made, and perhaps most importantly, how the buyout will be funded. A buy-sell agreement creates a contractual obligation to purchase a departing, a deceased, or business owner's interest if he or she becomes disabled. To be effective, funds need to be available to make the prescribed purchase. Basically, there are 4 ways to fund a buy-sell agreement: from cash flow, through the use of a sinking fund, borrowing the money, and with insurance proceeds. Let's look at the cash flow funding method first. The business owner who believes that the business can generate enough dollars to fund the buy-sell agreement is taking a risk. Economic downturns or other market conditions beyond the owner's control may reduce cash flow and make it difficult or even impossible for the business to support the buyout. A business faces the crisis of losing a leader when a business owner dies. A few questions to consider when contemplating this method are: how will this affect future cash flow? At the owner's retirement, can the business generate enough cash flow to support new management salaries as well as pay the departing owner? These are all very, very good questions to keep in mind. Preparing for a future event is not a bad idea. However, death, disability, or an owner's departure can occur without notice and sooner than expected. Where will the funds come from to buy him or her out? Premature death or unexpected disability can wreak financial havoc if the funds put aside fail to match the need. Then, of course, there's always borrowing. The loss of a key player may impair the creditworthiness of both the business and the remaining owners. Banks and loan institutions may be reluctant to lend money to the business or the remaining owners. In addition, interest costs may be excessive. For these reasons, borrowing the funds may be impractical and expensive. Lastly, let's look at life insurance. A buy-sell agreement funded with life insurance is often the most economical and practical solution, especially when the business owner plans to die with his or her boots on. Life insurance provides a specific payout at death, regardless of when death occurs. When cash value life insurance is used, the policy may serve double duty, providing both an income tax-free death benefit and potential cash value accumulation on an income tax deferred basis. Life insurance can be a cost-effective method of prepaying the purchase price of a business because premium costs are usually lower than the death proceeds, and the death proceeds are generally received income tax-free under Internal Revenue Code Section 101A, like Adam. However, it should be noted that for employer-owned contracts issued after August 17, 2006, the death proceeds in excess of the cost basis are subject to income tax, except where employee notice and consent requirements are met, and certain exceptions apply. In addition, businesses must fulfill annual information reporting requirements. The starting point to understanding when the death proceeds are subject to income taxes is to recognize what the Pension Protection Act, which added Internal Revenue Code Section 101J, J like Jack, calls an employer-owned contract. An employer-owned contract is defined as a life insurance contract that, number one, is owned by a person engaged in a trade or business, applicable policyholder as defined by the law, and number two, under which such person or related person as defined by the law is directly or indirectly a beneficiary. And lastly, that covers an insured who is an employee of the trade or business of the applicable policyholder on the date the contract is issued. Clearly, this definition includes policies where a business is the owner and beneficiary, such as policies funding a stock redemption or entity purchase buy-sell agreement. What is not so obvious is that under the applicable policyholder and related party definitions, the legislation expands its reach to a broad group of individuals and entities, and consequently may apply to cross-purchase and trusteed buy-sell agreements. Congress apparently was aware that this broad definition could negatively impact many valid business uses. So Internal Revenue Code Section 101J includes a number of exceptions. However, the exceptions only apply where the employee receives notice of and consents to the following in writing prior to policy issue. First, the applicable policyholder intends to insure the employee's life and specifies the maximum face amount for which the employee will be insured at time of issue. Second, the employee consents to being insured and agrees that such coverage may continue after he or she terminates employment. And third, the applicable policyholder will be the beneficiary of the death proceeds paid. Meeting the notice and consent requirements is a critical first step to avoiding taxation of death benefits. However, notice and consent is not the only requirement. Employer-owned contracts must also fall within one of the following exceptions. Insured's status. This exception provides that the income taxation rule will not apply to employer-owned contracts provided the insured was either an employee at any time during the 12-month period prior to death, or a director, a highly compensated employee, or a highly compensated individual at the time the contract was issued. So to recap, what Section 101J says is that there are requirements that must be met in order to make sure that the death benefit is paid out tax-free to the company. Therefore, there are two major things you need to remember to do. First, the company needs to give the employee notice, and the employee needs to provide consent that it's okay to buy life insurance on their lives. And there is a specific form that needs to be utilized to get this notice and consent. Second, once the policy is in force, annually, every year, the company needs to file Form 8925 on their taxes regarding to all the life insurance the company owns on employees. So that's Form 8925. If the company does these two things, the death benefit will likely pay out tax-free. If either one of these is missed, the death benefit potentially could be taxable, and we don't want that. One of the concerns is that notice and consent must be done before the policy is issued. If it's not done, that life insurance policy can never become compliant with this code section and will likely be taxable. So make a note. You want to first discuss life insurance filing requirements with your tax preparer as it relates to IRS Section 101J. And that's J like Jack. Okay? Cool. This next video looks at creating a business buyout plan.
Create a business buyout plan now. The Bard of Avon once said, "Better 3 hours too soon than a minute too late." When it comes to business, nothing could be more on the mark than that Shakespeare quote. Like any Shakespearean drama, there's a cast of characters that each play a vital role when determining how a business develops a buyout plan. Meet the Woofer and the Hoofer clans. They own the Big Dog Bone Natural Treat Company, Big D. Even though the Woofer and the Hoofer clans are in business together, they've had their share of relationship battles. Despite tough times, Wally Woofer and Holly Hoofer have managed to create a successful business together. Big D's financial advisor told Wally and Holly that if they don't have a business buyout plan in place and one of them dies prematurely, the survivor may wind up in business with their partner's heirs. Wally and Holly wanted to have a business buyout plan, but were worried that it might be too complicated to achieve. Their financial advisor told them there were several ways to put the buyout plan together so that in the event of a premature death, the clans would not have to think about what needed to be done. The surviving clan would buy the deceased clan's shares in the company. Wally and Holly wondered where the money would come from to buy their partner's share of the company. Their financial advisor said, "That's the easy part. The buyout agreement will be funded by a life insurance policy and, depending upon what the agreement says, the money will go to the descendants' clan and ownership of Big D will go to the survivors' clan." Now Wally and Holly are smiling as they go barking off to the bank, and not a minute too soon.
A successful family business is a cornerstone of many families' wealth. But passing the business along to the next generation takes substantial planning and preparation. A recent PricewaterhouseCoopers report found that While just over half of the family-owned business executives wanted to pass on their business to their children, just 27% of these companies had a robust, actionable succession plan in place. Let's say, for example, you have built a successful business that you now manage with one of your 3 children. As the sole owner, you have realized for some time now that in order to pass the business on to the next generation, you will need to do some careful planning. While the business is one of the most valuable assets in your estate, the planning needed to keep it in the family may be more intricate than you realize. You can use the flexible features of life insurance to help keep the business in the family and equalize the overall inheritance for all your children. So, what are some of the planning issues? How do you make sure that your spouse does not become an unwilling owner of the business at your death, but receives a fair value at your death to assure his or her financial security? How do you make sure that the business is passed on to the child or children who are truly interested in its continued success? How do you value the business that is transferred to the child active in the business? How do you make sure that the children who are not pursuing careers inside the family business will receive a fair inheritance? These are issues that can often be addressed with a buy-sell agreement between the owner and the child who plans to remain active in the family business. Frequently, the family and its advisors recognize that a life insurance policy is an effective funding vehicle for the buy-sell agreement. This is especially true when the family prefers the purchase price for the business be made in a lump sum rather than installments, or does not want to fund the payments with distributions from business operations. Here are some important things to keep in mind. Make sure you have chosen the appropriate business entity. You can't pass on an existing family business as a sole proprietorship or general partnership. You can pass on the assets, but not the business itself. Also, you can't pass S corporation shares to a non-resident alien. Discuss these matters early. It's important to get family input years ahead of time and involve them when discussing business successor planning. Sometimes family members may not want to go into the family business. The sooner you know, the sooner you can make other succession arrangements. Have a will and buy-sell agreement in place. All shareholders should have a will precisely defining what happens to their share of the business upon their death. Without a will, a deceased owner's interest would automatically go to his or her spouse, children, or other next of kin according to state default intestate laws. But the heirs may not want to be involved in the business. A will and a buy-sell ensure that control of the company will remain with the people committed to the business. A life insurance policy on each shareholder with the company or with the other owners as beneficiaries may be a good way to ensure that there will be enough cash available to buy out surviving spouses or other heirs of any deceased shareholder. Consider passing on ownership, but not management. Sometimes adult children of entrepreneurs may not be in a position to manage the day-to-day business, but they could be excellent as directors and shareholders. In this case, work on recruiting and developing outside management to run the business as employees. If this isn't practical, it may be best to explore selling the business outright. Also, make equitable arrangements for other children. If you have multiple children, chances are at least one of them will not want to take over the family business or will be unable to do so for any number of reasons. Possible solutions include start amassing assets outside of the business as soon as possible. Own life insurance sufficient to equalize the inheritance. Divide the business ownership into voting and non-voting shares in order to give the most capable or involved child operational control without disinheriting the others. Provide for the founder income security. The business should provide an income for the founder and their spouses for as long as they live. Possible techniques include purchase. The founder's children will pay the founder outright in cash for his or her shares, either in a lump sum or installments. Next option would be preferred stock. Convert the founder's interest from common stock to preferred stock. The founder doesn't get to vote shares anymore and no longer controls the company, but preferred stock dividends get paid first. Nobody can take any dividends out of the business unless the preferred stock dividend is paid. Upon the founder's death, a preferred stock goes to the surviving spouse, then gets passed on according to the last will and testament. You can consult your tax professional for details. The following short video gives us a recap on the importance of having a business succession plan.
The importance of having a business succession plan. The Magnificos have been making the best pizza throughout the 5 boroughs of New York for 5 generations. The last of the Magnifico patriarchs, Antonio, wants to continue the legacy and pass the family business down through future generations. But in order to do so, he needs to make several decisions about how future dough may be made and how will the business be kept in the family. Having a business survive from generation to generation is difficult and takes more than just a secret tomato sauce recipe to achieve. Whether your business is a chain of popular pizzerias or ritzy hotels, at some point, in order for the business to successfully continue, the owners must decide who will take over future ownership of the business in the event of the retirement, disability, or death of current ownership. And while that might be as obvious as a short putt on a long green, frequently choosing the right successor is neither obvious nor easy. While your successor might become the owner of your business in an instant, becoming an effective manager of the business is not an overnight process. Acquainting a successor with the intricacies of the business and preparing him or her to step into management's shoes in order to maintain the company's momentum could take years. Having a well-ordered succession plan is essential to business continuity, and part of a strategic succession plan is also structuring an insured business buyout plan funded with life insurance and an estate plan, all wrapped into a neat package. Using life insurance to fund business succession, buyout, and estate planning needs may settle the problem of how to treat all of your heirs. Whether you're a 5th-generation Magnifico ready to pass the rolling pin down to a son or daughter, or the noble owner of those posh hotels seeking an exit strategy, you'll need to assemble a competent team of knowledgeable advisors to help you crown the next generation of company management.
A one-way buy-sell is a strategy designed to transition a business from a sole business owner to a key executive or a group of executives. Many small and medium-sized businesses just have a sole owner. These business owners may find buy-sell planning difficult because there are no additional owners to buy or take over the business if the owner wants to sell his or her interest in the business. Luckily, some small and medium-sized businesses have a key executive or a group of executives to whom they want to sell the business to at the business owner's retirement, death, or another specified date. The one-way buy-sell business succession strategy is a design that may ensure that the business successfully transitions from the business owner to the key executive. Working with their tax, legal, and financial advisors, the business owner and the key executive will enter into what is called a buy-sell agreement. The agreement will require the business owner to sell and the key executive to buy the business at an agreed-upon price or at the occurrence of a triggering event, such as the business owner's death, disability, or retirement. The key executive working with a life insurance producer will purchase and be the beneficiary on a life insurance policy insuring the business owner's life. If the triggering event is the business owner's death, the key executive will generally receive the life insurance policy's death benefit income tax-free and may apply those funds towards the purchase of the business from the business owner's estate. If the business owner decides to sell the business to the key executive during the owner's lifetime, the key executive may access any available policy cash value to assist with the purchase. Often, participants in a buy-sell agreement will attempt to fund the arrangement using term life insurance policies. Term life insurance may suffice in some instances, but in others, a cash value life insurance policy may be a more appropriate funding mechanism for a buy-sell agreement. While a term life insurance policy may be less expensive in the early years of the arrangement, a cash value life insurance policy may provide the key executive with the following benefits when compared to a term life insurance policy. Often, a one-way buy-sell occurs for a reason other than the death of the business owner, such as retirement, disability, or specified date. The key executive may use a cash value life insurance policy as a vehicle to accumulate cash to be used for a lifetime buyout. For a successful established business, the cash value policy may be a better option for a long-term agreement. The cash policy provides death benefit protection for the lifetime of the insured, assuming the policy is properly funded. Term life insurance policies provide coverage for a limited time period, for example, 10 years. At the end of the period, term insurance premiums may be more costly than a cash value policy or even cost prohibitive. A cash value policy allows the key executive to access any available policy cash value for emergencies or other financial needs. So when we look at advantages versus disadvantages, the advantages would include the business owner will have a willing buyer for the business at his or her death. The business owner will know that the key executive will be the person managing the company after the business owner's death or retirement. The proceeds from the sale may provide a source of income for the business owner's family after his or her death. And the key executive will receive bases in the stock equal to the purchase price. Disadvantages would include the business owner must rely on the key executive to actually purchase the business after the business owner's death or retirement. The key executive must pay the premiums for the life insurance policy. The life insurance policy's cash value would be includable in the key executive's estate if he or she were to predecease the business owner. And then the business owner's family would no longer own the portion of the business sold to the key executive. Here's a video explanation on how executive compensation plans work.
How executive compensation plans work. Meet Tim Cratchit, a 45-year-old married man with 3 children. He's a talented software programmer who's been with Dickens Systems for years. Dickens management considers him to be extremely valuable. They also realize, however, that Tim might be lured away by a competitor who may offer better pay and benefits, and that concerns them. To create an incentive for Tim to stay for the long term, Dickens and Tim enter into an agreement whereby the company agrees to pay either retirement or death benefits to Tim in exchange for his promise to remain with Dickens. Their agreement states that if Tim stays until retirement, the company will pay Tim $20,000 a year for 10 years after his retirement. If Tim should die before he retires, the company will pay his family $20,000 a year for 10 years. If he should die during the first 10 years of retirement, the company will pay Tim's family $20,000 a year for the number of years remaining in the agreement.
The company informally funds this unsecured promise with the purchase of $200,000 of life insurance on Tim's life. The company completely controls and owns the policy. Creating this executive compensation arrangement with Tim gives Dickens management greater assurance of Tim's commitment to stay until retirement. With this assurance, they feel like they've won in many respects. In addition, the benefits paid by the company as reasonable additional compensation are an ordinary business expense that may be tax deductible to the company. But Tim also wins. He gains an additional source of retirement income, and if he dies prematurely or during the first 10 years of retirement, he gains an immediate payment to his family. Because of the variety and complexity of executive compensation arrangements, both the business and the employee should research available options thoroughly to ensure that they accomplish their specific goals and objectives. The best bet is to work with a financial professional to pull it all together.
So to recap, life insurance can be a highly effective vehicle for financial protection and a way to help increase the wealth that passes to your beneficiaries, in some cases over several generations, especially when properly structured in an irrevocable life insurance trust for estate planning. A life insurance policy can provide death benefit proceeds free of federal income tax and are generally free of estate tax. Life insurance can also help a business owner protect their business. To obtain the level of insurance needed, many individuals and business owners may have to liquidate assets to cover life insurance premiums. For business owners who are looking for a life insurance strategy with a potentially smaller impact on their assets, a premium financing arrangement might be a viable option. So, what is commercial premium financing? Basically, commercial premium financing is about using leverage as a wealth management strategy. It offers high net worth individuals and businesses an alternative method of funding life insurance premiums. With commercial premium financing, funds needed to pay premiums are borrowed from a third-party lender so that the borrower's current investment portfolio or other assets may continue to potentially grow. It is also a way for clients to minimize out-of-pocket costs and gift tax liability. As a person's wealth grows, so does their potential need for life insurance. If a small business owner has a significant life insurance need, but prefers not to liquidate potentially high-performing assets or family-limited partnerships to pay for premiums, there may be a better way. Commercial premium financing is an opportunity to purchase life insurance without disrupting a business's current investment portfolio. The idea is that funds are borrowed at a loan interest that is currently lower than what is expected to be earned on investments or other assets. Insurance protection is obtained with minimal disruption to the business's portfolio using life insurance assets as collateral. At a selected time in the future, the business pays back the loan principal with a planned rollout technique, or if death occurs earlier, at which point the death benefit will pay the debt. Some of the potential benefits of premium financing include: number one, the ability to reduce the out-of-pocket costs of life insurance premiums. Number two, with premium financing, one can obtain needed coverage and maximize the time value benefits of money without liquidating high-performing assets. Number three, obtain an interest rate on borrowed funds that may be less than the rate one would expect to earn on his or her investments. And then number four, the benefit of having potentially beneficial gift tax ramifications, as the grantor will generally need to gift the interest payments only rather than the entire premium payment. Other things to consider include: number one, premium financing is only available to high net worth individuals trusts, partnerships, and corporations. Number 2, the annual premiums are typically in excess of $100,000, and the policyholder's net worth is generally at least $3 to $5 million. Number 3, the insurance policy is often owned by an irrevocable life insurance trust. Fourthly, there should be a planned strategy to repay the debt in the future. Number 5, market fluctuations may affect loan interest rates and could make the strategy less attractive. And number 6, loan interest to purchase or carry life insurance is generally not income tax deductible. So applicants should seek the advice of their own tax and legal advisors with respect to tax consequences and individual business needs. This final video recaps premium financing.
Everything in life is bought with cash or financing. The banks are willing to finance anything that they feel is a safe investment, and the loan is backed by an asset as collateral. Obviously, you have heard of the banks financing cars, boats, and houses. But did you know the bank is willing to finance your multi-million-dollar cash value life insurance policy like an IUL as well? They know they will get their money either through the cash buildup or through the death benefit, and the loan is backed by additional collateral, so the banks feel safe in lending their money. Once the bank loan is repaid through the cash buildup, you end up with a multi-million-dollar free and clear asset that can be accessed by you while you're living or your beneficiaries when you pass 100% tax-free. This money can be used for any purpose, including supplementing your retirement income, paying for medical expenses, long-term care, investments, or simply playing. Just like with any bank financing, you have to qualify for the loan and show that you have the financial capacity of making the annual payments. However, with this loan, you could potentially defer all of the payments until the end of the loan and pay it off in one balloon payment from the cash value of the insurance policy. To find out if premium financing is right for you, get back with the person who shared this video with you.
Transitioning your business is a huge event. You need to make sure you have a trusted advisor or agent to help. A great agent will walk you through the entire process. Our agents have helped hundreds of business owners prepare for life's transitions. Contact us if you're thinking about business owner retirement plans. We can show you your options to ensure that your retirement and succession is as hassle-free and predictable as possible. All right, well, unfortunately, I'm limited by time. And as a token of my appreciation, everyone on the call will have access to a free ebook from SafeMoney.com entitled The Retirement Report. This way, you'll be able to grab a hold of retirement planning strategies I wasn't able to cover in this webinar. Simply go to my Safe Money membership page by logging on to independentwealthplanner.com and scroll down to the ebook section. We actually have 3 books available right now. Feel free to download whatever booklet interests you. I've been getting a lot of positive feedback about the 3 booklets. Since I am a member, there's never a cost to you. Just let them know I referred you. So where it says enter the name of the referring advisor, just type in Jennifer Lange and you can get the book for free. Also at SafeMoney.com, you'll be able to view articles and learn more about life insurance and retirement planning. We have loads of information and content available for free on this website. Simply log on to my member page, independentwealthplanner.com, to get access to all these resources for life insurance and retirement information. And of course, if you have any questions or would like to have a free financial needs analysis done, contact me via my website, wfginsurancequotes.com. I'll be happy to help you. Thank everyone for attending and have a great day. Until next time.